Hello, everyone. How are you doing? Thank you for being here as well. So the idea for this panel is for us to share a little bit of our insights as investors on climate tech. And hopefully this will be useful mostly to founders, which are the ones that are really creating the low carbon future. I've had my notes here, so allow me to use my phone. So first I want to ask you to introduce yourself and let us know what are the key, maybe 3 things that distinguish your fund's attitude towards climate tech. Want to start?
Thank you so much. My name is Louise. I'm investment manager at HV Capital. We're based out of Berlin. I concentrate on B2B marketplaces and climate tech. We're investing out of a 710 million vehicle, investing from pre-seed to Series D. So get in early and go the entire way, and can go up to 100 million per portfolio companies if you really think there's some winners around them. And I think for us, it is really the next wave of doubling down on climate tech. We've built a large network over the 25 years we've been active, and see a lot of support within our kind of older portfolio that are going towards climate actions, and now also our newer companies with, for example, Agrina, Enpal, Plan A, that really drive climate action. And we get very excited, and it's definitely also something we want to double down on. Our latest fund is an Article 8 fund, which means that 30% of our volume will be dedicated to startups that are supporting climate action.
Thank you, Luis. And let me ask you, are some of your successful former founders now coming into climate tech?
Yes, actually. Like we see, for example, a deal I've done in January, it's EcoPlanet. They help industrial SMBs to engage in the energy transition. We have actually support from the Flixbus founders, from the Sender founders as angels that really drive this ecosystem effect in our portfolio.
That's great. Yes, thank you. Pierre?
So hello everyone. So my name is Pierre de Villard. I'm a managing director in the Eurazeo Smart City and Climate Venture team. So we have a fund which is a bit more than 400 million euro. This is a strategy that we've launched about 15 years ago. It used to be called clean tech. Then clean tech became a word that no investor wanted to hear. So now we are talking about climate tech. So we're hoping that it's going to be a better second wave. So what we do is we invest basically late seed, Series A, Series B, sometimes small Series C, all across the world. Still we focus on Europe and Southeast Asia. What we've been building along the years is a lot of partnership with corporates. We have the feeling that climate tech is tough. It involves hardware, it involves operation. We're still seeing few pure SaaS digital companies in the space, but decarbonation and pure digital doesn't work really well. You always have some assets, some operations. And so as it's tough, we've tried to build different value drivers to support our portfolio. So one is the relationship with corporates. So we have a bit more than 20 corporates, German, French, Asian, all across the world, that are helping us, I would say, in a way to accelerate what our funders are doing. The second one is that we're trying to leverage the Eurazeo platform. Eurazeo is managing a bit more than 35 billion euro of assets, so we have 12 offices across the world. So we like international story. We have a strong experience in bringing companies to the US, to Asia, and we believe this is a clear add-on we can bring and what makes us a bit different. And the last one is that we've built a team with people that have experience both in, I would say, infrastructure, in venture, in growth buyout, because we're starting to see that a startup to grow in this field will at some point need to have some asset financing and structure it properly, because again, you have asset, you have hardware. You will need to organize operations and so on, so it's problematic that are more used to growth and buyout and so on. So we're trying to bring, I would say, complementary team of experience to support the growth of our companies. So that's why we hope make us a bit different.
Thank you.
Nitin Lal from ICOS Capital. We also got started around 2006, investing in sustainability. And sustainability tech is hard. It takes a long time. So we don't obviously focus on the pre-revenue companies. We invest in more when you have about $1 million revenue or more. And we work together with corporations that have the urgency of realizing net zero. So if you have solutions that are focused on industry solutions, where the industry is the client, we also have investors that are investing in our funds and like to work with our portfolio companies as well. One important thing I would mention is it's not only carbon, but also cost leadership. Products need to be cost competitive and carbon competitive. So the traditional use of let's make grid money is still valid, very much, but now on top of it, you need to have an impact. And I think that goes for not just an impact company, but for any company.
Thank you.
Cool. So hey everyone, thanks for coming and thanks Alexis for arranging this panel and obviously a lovely panelist discussion. So I'm Patricus, I'm from Contrarian Ventures. We are an early stage climate tech focused fund. Climate tech is something that we describe through the lenses of decarbonization. So if you look into climate equations, there is 4 major contributions to emissions that you need to reduce or decarbonize. So that's energy, transportation, built environment, and industry. Then obviously there's going to be some of the emissions that you can't reduce and you'll need to offset. So then comes the more, let's say, novel sector of carbon markets. And then obviously some of the damage we just can't change, it's already been there, so that comes the climate risk, adaptation, and mitigation. So we invest within those 6 buckets all across Europe and Israel. So far done 24 investments. I think what's very important for us as seed stage investors is 2 metrics that we track within our portfolio. Metric number 1 is graduation rate from seed to Series A. And that's very specific for climate tech companies, obviously. And metric number 2, portfolio ENPS. So we basically held our portfolio founders as evangelists, which help us bring deal flow, which even assist in the diligence with some other companies. So we really try to keep close to them. And I think most probably the last thing on our side, and referring to most probably Nitya and Pierre, where they started much more earlier. We started in 2017, when again, it was not a word and was a bit different back then, but we've been always taking this platform, open and collaborative approach to get everyone in one space, educate that there is a lot of opportunities to be done in climate tech, there is funding for this. So we run this huge community platform on climate tech side of things. We run one of the largest energy conferences, startup pitch competition again for energy startups, and then climate tech VC list ranking. So again, just democratizing access for entrepreneurs to climate tech and facilitating the financing.
Thank you. I think that is enough of pitching our funds. Now let's try to deliver the insights. I wanted to ask you, what are the key takeaways from investing on climate tech these years? I would say that for us it's embracing complexity. VCs, we tend to try to avoid complexity. We tend to simplify, to create frameworks, but the climate crisis won't be solved just by that. We need to embrace complexity in the investments that we made. So I want to ask you if you can share a few takeaways from learnings. Whoever can take the first one.
Cool, I can continue on rambling. So on our side, I think there is an interesting trend and there is an interesting need in so you look climate tech, there are most probably, if we overgeneralize things, there are 2 different solutions. So one solution is software, and there is a software platform and nothing more to it. And then on the other side, you have completely different hardware, deep tech kind of, so if you take company examples, one would be, hydrogen, carbon capture, something similar, which requires a lot of capital, and some other would be a software platform for solar engineering or whatever. So I think one really big trend we observing up to this date, that obviously we'd love to have more funds focused on the hardware side of things. But even so, if we get those people on board and focused, there is still this gap of financing for later stage hardware companies, where for venture capital funds, so they come to this specific stage, and for venture capital funds, it's too late, and the return and risk and return is too low. And for infrastructure, it's the same. So some of these startups end up in this middle way of not getting financing and looking for specific solutions, which are not yet there developed. But I think on the positive side, there is guys like S2G Ventures from Chicago raised a $300 million fund, and they actually trying to fill that gap where they put 10 to 30 million and aim for 12 to 15% annual return, and kind of filling that gap where no one is willing to play and no financial instruments are yet to be found in that space.
Thank you. Very good. Pierre?
Yeah, I think on our side, and this is a bit back to my presentation first, was that when you look at, obviously software is what every VC would love to see in the climate tech, but we don't see that much, and at the end most of them are very vertical software, which is a bit difficult to exit sometime. So there are two main points that we look at now when we invest. The first one is, from scratch, what's going to be the exit? And sometimes people go in the adventure, but they don't think about what's going to be the exit and what the people are going to look for. And it's very important from scratch, will I sell a technology, will I sell a cash machine, and to focus on building something that will sell. And climate tech, there is not that many buyers at the end. When we look at the industry, are not paying very expensively. If you want to look at PE exit, then you will need to have cash. IPO, there's been a lot of IPO without EBITDA. We've seen that sometimes it doesn't go that well. So it's very important from scratch to say, what do I want to build? Is it a cash machine? Is it a pure tech? And focus on that all along the way. So that's the first element, but to have this story kind of in mind from scratch. The second one is, most of companies in climate tech, they have assets. There is hardware in a way. And it's very important to look at them kind of a unit economics, as we could do on software, CAC LTV and so on. And it's very important to have a mindset of an infrastructure investor when you look at those companies. Is the asset profitable? What's the payback? What's the IRR? All those, I would say, KPI, which are not very used to for VCs usually, but you need to have that in mind from scratch and be sure that what you are delivering and developing will be bankable and will be acceptable for people who are thinking this way, which are infra players, PE players, and even corporate and so on. So very focused on the unit economics, even when you look at hardware. And so those would be the two key elements we're looking at.
Thank you so much. Nitya?
Yeah, so I go back to what I mentioned, cost and carbon leadership. So when you start out in a venture, look at how and when your product will be cost competitive, and that is really the point when market will come to you. Rather than trying to build something which is 5 times more expensive, but then you try to sell it on sustainability credentials. It didn't work in 2006, and I think it still doesn't work. So you really have to be careful and focus on making sure that you have cost competitive product that sells and carbon leadership on top of it.
Very good, really strong. Thank you, Luis.
I definitely agree with your point about cost competitiveness. We have, for example, one company in our portfolio I mentioned earlier, Greener, that actually convinced farmers to adopt regenerative farming methods, where they would experience an initial drop in yield, and they actually offset them by giving them the earning of carbon credits. So what they actually do is making this concept financially viable for them, and thus are able to actually get into this target group, which is not always easy to conquer, much easier because it makes economic sense. And maybe an example from another portfolio company, given that climate tech companies are often have a background in regulatory changes or scientific advancement, it doesn't always need to be. For example, Enpa, they took an existing kind of infrastructure of solar panels and just really innovated on the go-to-market. Now it's, of course, a bit longer ago. It wouldn't be called an innovation today anymore, but just made the journey of adopting to renewable energy so much easier for and like financially feasible to the end user.
Mm-hmm. Absolutely, yeah. Thank you so much. And we see a lot of new people coming into climate tech, because climate tech is now, well, we have this panel, right? It's now a thing. So what would be the advice for the newcomers, for the people that are just starting to think about building something and tagging it as climate tech?
Should I continue?
Yes.
We have like a nice rhythm.
Yes.
So I think one learning would be a little bit, don't get kind of catched by the hype. Like really think about what you're wanting to build if you're in for this journey for the next 10 years of your life, and not just because it gets a lot of VC attention, like with this dedication towards it. Then especially in the earlier teams, make sure you have an edge into the market, kind of from the background as a founder perspective. If you're targeting scientific problem, make that reflected in your starting team. I think this is a huge help to kind of get this initial funding, especially if you don't have a product, etc. And lastly, maybe VC funding is not always the way to go. In climate tech, it's been discussed, there might be much longer development cycles beyond 10 years, which is our investment frame, where we really need some kind of revenue to realize the exit, as mentioned. So maybe not all impactful climate tech solutions are made for the VC world.
Mm-hmm. Thank you so much.
So what I would recommend is to look at the past, because there has been so many trials. There has been a lot of failure. So climate tech is very tough. I mean, as we've said it. Try to learn from the past. The context overall has changed a bit. Obviously, there is more focus on those topics, a bit more money to invest. But at the end, you need to learn from the past and see what has been done, what has been talked to other companies, because we've seen a lot of, indeed, entrepreneurs from the digital space going into climate tech. Okay, I've made my money in digital. I'm going to do climate now. I want to have an impact. And then they start to put their feet into hardware and so on, and they are not just built to do that. So be really well aware of your strength, and indeed build a team that is complementary to you if you're coming from the digital world, because climate tech is not digital. I mean, that's at the end, that's it. And to try to see what has happened, learn from the past, because there's been a lot of mistakes made. Some sectors are just not made for VC. And so learn from that, because again, clean tech has been existing for many, many, many years. So try to focus on things that you
and
can
Pierre, and maybe Luis, could you mention some sectors that are not fit for VC?
Yeah, I don't want to discourage everyone. But, no, but I think the pure hardware stuff, deep tech stuff is tough. That's kind of a learning. So unless you really have something which is crazily revolutioning everything, it's tough. I mean, if it's that's a bit the learning, sadly, for VCs. I think tech-enabled solution operation works really well. We've seen companies like Enpal and so on. Going into market which exist, when we look at energy renovation, for instance, people are digitalizing that, starting from operation that exist and so on. But like the long journey of 15 years tech development is tough for VCs to be clear. So you need to have corporates, you need to find your way, but unfortunately, that's maybe not us that will be able to finance that.
Mm-hmm. Of course. Thank you.
Well, I come back to my cost leadership point. Don't go into things like bioethanol when you're competing with something that you cannot beat. Same thing with, there's a lot of hype and a lot of interest in bioplastics. We love bioplastic, but be prepared to find €500 million financing to finance your factory. And, realistically speaking, rather you work out with a corporation there and make a deal than go into a venture funding market and say, yeah, give me first 5 million, then give me 100 million, then give me 500 million, then I'll be the big bioplastics company. So there's a realism that needs to come in. Mm-hmm. You have, go for big enough problems, but don't go for a problem that just totally hogs all the money that you want, and which is, especially in Europe, it's unraisable for now. Mm-hmm.
Yeah, I think maybe to build on that, we've seen many companies in the past that were coming with a very nice technology on plan, which was, okay, today my cost is 1,000, but if I get volume, I will get to 10. But no one was ready to finance the cost curve. So you have to be competitive very fast, I fully agree. And don't bet on customers or the market to finance this cost reduction, because that usually never happens. No one wants to buy and losing money, and VCs now to finance a cost curve this way is too tough. So don't bet that volume is the only driver that will get you to market. Usually is one mistake that we've seen a lot, and people are just not getting the volume, so staying uncompetitive.
Thank you.
Cool. Continue to build on what the colleagues said. I think first and foremost, I think Louis' very good point. Be honest and be truthful to what you're building and to what problem you're solving. Because I think if you've been, and most probably you've been in the space for quite a while, you see that nowadays there's just much more of the same, which used to happen in 2019, 2020. You just, same solutions come back with a little cherry on top and being presented as a novel things, which is not always the case. Then I think another great point, and that's again to the patient capital, or the capital which is more so long-term, that there is a lot of patient capital in the space. And patient capital in the space referring to most probably corporate venture capital funds who have a longer period of deployment. So definitely building hardware tech solutions, you can tap into those. But I think one has to be really cautious on when they should take them in, at what kind of company journey. And at least we usually suggest or advise to people, take something else than the funding from them. For example, contract or offtake or whatever they can offer for your company. And then I think for the last one, and that was a learning on our side, be quite strict and reasonable while doing your market sizing you plan to be playing in. Because in climate tech, a lot of the stuff is still new, is still nascent. So most of the time, the typical McKinsey, BCG, 1 trillion type of opportunity doesn't work. And reality is you do back of the envelope calculations, multiply 4 numbers, and you suddenly understand that instead of 2 trillion, which McKinsey wrote in the report, is actually, 50 million in total. Or the market is non-existent, and then you're betting on something that might exist in the future. So I think this one you also have to be very cautious. But hey, on the positive side, I think there's been very recently a study or a survey done by University of Yale on a global survey on business students and what they want to do in their life. And actually 40% of the people responded that they want to do something with sustainability. So I think happy to see more and more talent flowing into the space from multiple angles.
Yeah, absolutely. I think talent acquisition is by far, let's say, easier for climate tech companies in this context. They are able to hire amazing, experienced people for very early stage businesses, and that is great. And one question I wanted to ask you as well is,
what's your view, Alex?
No, I very much I'm very much aligned with what you say. I think we have to be cautious. I think when a sector is trendy, hot, it means there is an opportunity, and maybe some of those opportunities can be massive, but it also means that most of what is said is not true, right? So I tend to always side with scientists, We come here all optimistic, the venture capitalists, the founders, and in the end, scientists are usually right. So we need to have a very scientific approach to climate crisis solving, because otherwise we will be doing a lot of well-intended things that will have no relevance. So I wanted to ask you then in terms of regulation, because in the EU there's a lot of regulation tailwinds, and many times the founders come to us and tell us, but this new law is coming, like all goes in favor of my business. But timing is tricky. So how do you work with founders when they bring regulation to the table?
Just one thing, I would say the biggest threat right now is the Inflation Reduction Act in the US. That has totally changed the spectrum. Frankly, at this point in time, a climate tech company is better off building its presence in the US because of access to capital is humongous as compared to regulatory bound complex capital that you have here. Not something I would encourage people to do, but that's simply something that the European Union and European Commission needs to pay attention to, that the Inflation Reduction Act is effectively turned the tables. Quite possibly the next generation of climate tech will be in the US, not in Europe.
The European Union is always taking the stick approach, while US is always taking the carrot approach. So in Europe, they say, look, either you comply or you pay up. While in the US, you say, look, we'll adjust your price point. You'll be able to sell sustainable aviation fuel at the price that makes sense. So, but yeah, people were trying to stick up with the US, but I think not much progress on that front yet to date.
Yeah, I mean, I think that most of us invest only in European companies, I would say. So it is something that we all need to help build, right? It's not an ecosystem that will be built by the government in any way. Of course, we need to work with the regulators.
To add to that quickly, what we sometimes do, especially for companies that operate more in the traditional industries that are less digitized, is to consider an ambassador hire early. So like really get someone from the industry that's not necessarily like a tech-driven talent, but that just knows the structure, the in and outs, kind of where it's relevant to register, to be kind of popping up in the government recommended solutions, etc. So to really just get that intel, and it doesn't have to be like a full like forever hire, but for like 2 years, open the door, get credibility in the market, and also to really like factor in everything that's happening on the regulatory side.
That's super interesting. Yeah, super. And have you seen like good cultural fit in general?
Sorry?
Good cultural fit between.
Yeah, it's actually funny, like because I have this picture in mind. It's actually, I think you have to be very clear about the expectations, right?
Okay.
Like what actually one team is doing for us. They're using their ambassador hire as kind of a test customer because they're saying, okay, this is our ICP and our product needs to work for this ICP, like for the customer group, and so they're actually getting a lot more synergies out of it.
Mm-hmm. That's super interesting. I don't know if anyone here at the audience has a question for the panel. Yes, I think getting a mic.
Isn't reducing meat intake an easy way to a low carbon future? Are you considering those kind of investments in meat analog products?
I can answer that very quickly because we have a couple of portfolio companies that are, yes, focusing on reducing meat intake by many different ways. Some are alternative proteins, some are alternative fats. But of course, it's one of the major decarbonization drivers is bypassing the consumption of animal proteins. Yeah.
It's the same thing I mentioned about cost leadership. Right now, a kilo of cell-based meat will probably run you into a few thousand euros versus a few euros. So there's a process that is taking place. It'll take, 10, 20 years before we get there, but there is a process. There are companies that are making cell-based meat, so that's an alternative. Plant-based meat, plenty. Alternative proteins, we have invested in those are much more real, much more closer to the market.